Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now the World Bank set a gloomy note overnight as it released its Global Economic Prospects report. The bank cut its global growth forecast for 2022 to 2.9%, which was a sharp cut from its January forecast and a sharp slowdown from 2021's 5.7%. Developed markets were forecast to grow 2.6%, but emerging markets were expected to grow just 3.4% this year. The World Bank's downgrade of China's growth forecast to 4.3% was undoubtedly one key contributor, though I could not help notice that the 2.5% growth projected for the US was still above its long-term trend. On the converse side, Middle East and North Africa was expected to grow 5.3% this year, benefiting from higher oil prices, while South Asia was expected to grow at 6.8%. Now, in his comment, World Bank President Malpass said that the global economy could enter a period of feeble growth and elevated inflation, and said that the danger of stagflation was considerable. The gloomy outlook notwithstanding, though, the World Bank did note there were several differences between now and the 1970s, which included a stronger dollar, lower oil prices, and stronger balance sheets in the financial sector. Now, staying on the theme of this report for a moment, there were two notable events of the past 24 hours that we see as significant for investors and really continuing on some of the key themes brought up in that report. Now, the first was in oil, where several media reports quoted energy industry leaders and forecasters saying that oil prices were at risk of rising further. Now, these warnings came against several data points that continue to highlight a tight demand-supply balance in the energy market. Consensus is looking for a fall in US crude oil inventory data that's due later this week, but there's also focus on what's likely to be a rebound in Chinese energy demand as the economy emerges from COVID lockdowns, what appears to be still poor prospects of a deal with Iran, and some lingering doubts on whether OPEC's efforts to raise output can help cap prices, given expected output increases may not match cuts from Russian supply. Now, all of these events, of course, have meant that oil prices have remained relatively elevated, around $120 per barrel, which has been consistent with our own expectations. For investors, we continue to see energy sector equities as an attractive route to not only gaining exposure to elevated oil prices, but also creating some protection against the risk of a further rise. Now, recall this sector is one of the rare parts of the market which is up considerably year to date in what looks like almost a mirror image of the S&P 500 on the chart. Now, the second thing was in Australia, where the central bank raised rates by half a percentage point to 0.85% and signaled there was more to come. Now, this 50 basis points rise was well above consensus, which was looking for only a 25 to 40 basis point hike. And the RBA governor signaled the central bank had more in the pipeline, noting that inflation in Australia was, in his view, hotter than a month ago and that further hikes would be needed to normalize policy. For reference, Australian policymakers have indicated in the past that their estimate of the neutral policy rate was around 2.5%. Now, we see this upside surprise as positive for the Aussie dollar, which regular listeners will know is among our more preferred currencies. Recall that we see two pillars of support for the Aussie dollar coming from the likelihood of higher interest rates on bond yields on one hand and elevated commodity prices on the other, which of course could get a further boost as China's economy reopens from COVID lockdowns. Now, the AUD-USD pair was contained to some degree overnight for technical reasons as the post-rate hike rebound paused around the 200-day moving average, but we see technical support at 0.716 and believe a break of key resistance could push the pair higher towards 73.5 cents. So, two ideas to focus on today after the World Bank's relatively gloomy report, but let's not forget we still have several central bank events lined up to watch today, including India's RBI today and Europe's ECB tomorrow. But we'll take a pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.